Hello and welcome to our discussion on the business combination and consolidation or preparation of consolidated balance sheet. To recap, the relevant accounting standards which affect the business combination and the consolidation are IFRS 3, Ind AS 3 for business combination, AS 14 amalgamation, and IAS 27 is for consolidation. One of the most important issues in business combination is the determination of purchase consideration, and the purchase consideration can be determined on the basis of assets or can be determined on the basis of earnings or on the basis of the market price. So the determination of purchase consideration will decide the amount payable, and the amount payable depends on the assets or earnings or the market price. And once the purchase consideration is decided or determined, the organization is also required to decide about the discharge of purchase consideration, and the purchase consideration can be discharged in the form of cash or shares or bonds or a combination of any of them. And whenever there is a business combination, maybe one of the companies will become the acquirer or the majority shareholder, the others will become minority owners. In a standalone balance sheet of the acquirer, on the asset side, the shares acquired will be shown as investment, and the corresponding effect on the payment depends on the mode of discharge. It may result in the decrease in cash or increase in capital or increase in the bonds and debenture with a corresponding share premium, if any. So the discharge of purchase consideration will affect the sources side or the cash depending on the mode of the payment of the business or purchase consideration. We had discussed this particular problem. Let me show you that Excel. We saw that A and B, and we saw in a case 1 where the purchase consideration is 15,000 and discharged by cash. In the second one is a discharge by capital. So in one case the cash reduces but the share investment appears on the balance sheet. In other case, cash increases, the capital increases, sorry for that, and the investment appears on the balance sheet. But in this session we will try to understand the preparation of the consolidated balance sheet of A after acquiring B, and in this case, because A acquires around more than 51%, so we assume that they're acquiring control, so there is a need for consolidation. So the consolidated balance sheet is required if the company acquires control of another company. Control may be on the basis of the equity, sometimes non-equity based controls are also possible. The consolidated balance sheet will show the assets and liabilities of the buyer and the seller. That means of an economic entity. And the consolidated balance sheet shows the goodwill and the minority interest. So since we already determined the purchase consideration, goodwill is the excess of purchase consideration on the proportionate equity acquired, and we'll see that in that example. The minority interest, which is also called non-controlling interest, is the total equity of the seller less the majority acquired, but minority interest can also be determined on the basis of the fair value. So let us go back to that exercise. So I'm using the first case, that means where there is a discharge by cash. So let me pick up this balance sheet of a standalone and then do the consolidated. So we have this standalone balance sheet where the assets, the investments are acquired, 15,000, and that has been discharged by cash. So therefore cash has come down to the extent of 15,000. Now we want to prepare the consolidated balance sheet. The consolidated balance sheet requires the calculation of goodwill and the calculation of minority interest. The calculation of goodwill and minority interest requires the calculation of total equity of B, and the total equity of B in this case we are assuming that based on the book values given, because the fair value of the assets are not given, so we take that as the total equity of B. And of this 80% is acquired by A, so 80% is acquired equity by A, and the balance 20% is the minority interest. And purchased goodwill is the excess of purchase consideration, and the purchase consideration was 15,000. So minus the equity acquired by A, which is 7,600. So the excess money paid is a goodwill. So whenever you are required to prepare a consolidated balance sheet, it is required to find minority interest. Okay, let me highlight that. You are required to find the goodwill, which we have done. And consolidation is a line by line consolidation. That means the standalone assets plus the standalone assets of B and standalone liabilities of A plus the liabilities of B. So 18,000. The long-term debt 10,000 plus 2,200. Capital is just the capital of A, we'll discuss that, and reserves 25,000. We are not consolidating, or we are not showing or adding the capital and reserves of B with the capital and reserves of A. In the same manner, the consolidated asset will be the assets of A, cash of A with the cash of B, inventories of A with the inventories of B, with the debtors of A with the debtors of B. The shares of X was not there in B, so only, and this will not appear. We'll discuss why will not appear. The plant of B plus the plant of A will be. But as we discuss here, the minority interest, so let me just write down MI, will be shown in the consolidated balance sheet. And goodwill is the excess of money paid. Goodwill is the excess of money paid. So, and goodwill is an asset because that shows the future value of the business arising from this consolidation. So therefore, in a consolidated balance sheet, you come across a new term in the asset side, that is goodwill. On the sources side, you come across an item called minority interest. But at the same time, you see the capital and the reserves of the buyer, of the seller, are not added with the buyer. Similarly, the investments of A in B are not shown because that is adjusted by showing the assets and liabilities of B. Any excess money paid is the goodwill. Sometimes the goodwill can be negative, but later on we'll see what is the treatment of negative goodwill. To recap, in a standalone balance sheet, you'll show the investments in the subsidiary, whereas in a consolidated balance sheet, the investment in subsidiary, money paid for that is a purchase consideration, will not be shown, but that is substituted by the assets of B and the liabilities of B. But since you are showing the entire 100% assets and liabilities, there is a need to show the minority interest. So consolidated balance sheet will show, the CBS will show the assets of B, okay, assets of B plus assets of A minus the investments in B. Okay, minus the investments in B. Let me cut it down and put it here. Minus the, so minus the less the investments in B. Okay, the assets of A plus assets of A, okay, minus the investments in B. In the same manner, the capital and the reserves are not shown in the consolidated balance sheet. So the most important visible item that you can see on the consolidated balance sheet is a goodwill. But this goodwill is not the goodwill of A, but goodwill is the excess money paid by A to acquire the shares of B. In this case, the shares have been acquired for 15,000, but the acquired equity is 7,600, so that excess money paid is the goodwill. Thank you.